After a company decides to go public, it faces the problem of how to sell its stock to a large number of investors. Although most companies know how to sell their products, few have experience in selling securities. To help in this process, the company will interview a number of different investment banks, also called underwriters, and then select one to be the lead underwriter. To understand the factors that affect this choice, it helps to understand exactly what investment banks do in an IPO. First, the investment bank helps the firm determine the preliminary offering price, or price range, for the stock and the number of shares to be sold. The investment bank's reputation and experience in the company's industry are critical in convincing potential investors to purchase the stock at the offering price. In effect, the investment bank implicitly certifies that the stock is not overpriced, which obviously comforts investors. Second, the investment bank actually sells the shares to its existing clients, which include a mix of institutional investors and retail, that's individual customers. Third, the investment bank, through its associated brokerage house, will have an analyst cover the stock after it is issued. The analyst will regularly distribute reports to investors describing the stock's prospects, which will help to maintain an interest in the stock. Well-respected analysts increase the likelihood that there will be a liquid secondary market for the stock, and that its price will reflect the company's true value. Some activities in finance involve as much marketing skill as finance expertise. For example, the selection of an underwriter often is described as a bake-off in which the competing investment banks woo the company with their best sales pitch, much like a cake baking contest in which bakers vie for first prize.
The next step in the process of going public, the company has the choice to decide how to issue the sale of the security. There's two main choices here. We have a best efforts basis option and an underwriting option. In a best efforts option, a bank does not guarantee the funds to ensure that the security will be sold. This is more risk for the company, obviously, as they don't have a guarantee their security will be sold, but it's less risky for the bank. The second option, which is more common, is an underwriting option. In this option, the bank does guarantee the funds to sell at least some portion of the security. Now, in this choice, how does an individual bank minimize their risk? And to do this, there's underwriting syndicates. And what these underwriting syndicates do is they basically form a larger group of banks to help distribute the risk among these many investment banks. And further, selling groups take it one step further from these banks to flow down to the individual investor. And these banks include firms we've all probably heard of, such as Morgan Stanley, Goldman Sachs, Barclays, Credit Suisse, and others. These underwriting syndicates, they certainly help lead to higher exposure for the IPO, and in these cases it benefits both the underwriters and the issuers. On the horizon, there's a new selling procedure, and this is called unsyndicated stock offerings. And what this choice does is it bypasses the retail stockbrokers and individuals selling directly to institutional investors. Currently, this is approaching about 50% of the current IPOs that are out there. It's gaining in popularity. Advantages to this: lower issuing fees compared to syndicated offerings. Next, we will talk about the regulation of securities sales for IPOs.
Sales of new securities and also sales in the secondary markets are regulated by the Securities and Exchange Commission and, to a lesser extent, by each of the 50 states. There are four primary elements of SEC regulation. Jurisdiction. The SEC has jurisdiction over all interstate public offerings in amounts of $1.5 million or more. Registration. Newly issued securities, stocks, and bonds must be registered with the SEC at least 20 days before they are publicly offered. The registration statement, called Form S-1, provides financial, legal, and technical information about the company to the SEC. A prospectus, which is embedded in the S-1, summarizes the information for investors. The SEC's lawyers and accountants analyze both the registration statement and the prospectus. If the information is inadequate or misleading, the SEC will delay or stop the public offering. Among the disclosures, the S1 document and subsequent amendments, S1A, show the proposed number of shares to be sold, including a breakdown between shares sold by the company and shares sold by current stockholders, including the founders and investors, and a range of possible offering prices, the prices at which the first investors may purchase the stock. Number 3, prospectus. After the SEC declares the registration to be effective, new securities may be advertised, but all sales solicitations must be accompanied by the prospectus. Preliminary or red herring prospectuses may be distributed to potential buyers during the 20-day waiting period after the registration is effective, but no sales may be finalized during this time. The red herring prospectus, so called because it has a standard legal disclaimer printed in red across its cover, contains all the key information that will appear in the final prospectus except the final price, which is generally set after the market closes the day before the new securities are offered to the public. Number 4, truth in reporting. If the registration statement or prospectus contains misrepresentation or omissions of material facts, then any purchaser who suffers a loss may sue for damages. Severe penalties may be imposed on the issuer or its officers, directors, accountants, engineers, appraisers, underwriters, and all others who participated in the preparation of the registration statement or prospectus.
The next couple of slides deal with the activities leading up to the IPO once the aforementioned registration statement has been filed. The first activity is the roadshow. Here presentations are made to potential buyers. These typically last between 10 to 14 days with stops in 10 to 20 cities. The firm's senior management team, the investment banker, and the company's lawyers make 3 to 7 presentations per day. Potential investors will include existing clients of the underwriters. The two main purposes is to generate interest to potential investors and to present content from the registration statement. However, no information outside the registration statement can be given. This includes forecasts or opinions about valuation. This is because of an SEC mandated quiet period, which lasts from the registration until 40 days after the IPO. Feedback from investors to indicate their interest in purchasing shares is requested after each presentation. The second activity after the roadshow is book building. This captures potential demand by recording the number of shares and their potential price from those who are willing to buy. An IPO is said to be oversubscribed when investors are willing to buy more shares than what is offered. If this occurs, the investment bank will allocate shares on a pro rata basis. A third activity that must be performed is setting an IPO's offer price. We are going to go over a couple of scenarios that companies face to determine the price and work a couple of problems to exemplify how this is done. Now, a company will usually announce the day before the IPO the actual offer price. This can be a very complicated process, but the text provides two situations that occur that drive what the offer price will be. Firstly, a company may know how many shares it wants to sell. This is usually because the owners want to target what % of the company that they will retain. Secondly, a company may target a certain level of proceeds. This is done to ensure the owners will have the cash the company needs. It should be noted that there does exist a conflict of interest between an issuing company and the underwriter. The company will want an offer price to be high to generate more cash. An underwriter, however, will want to avoid an overvalued stock. They may have an interest to keep the price low. Okay, now we're going to work a couple problems. First of all, we're going to see a company, Kelly Corporation. We're going to figure out how to set their offer price when the number of new shares is known. So the problem is Kelly Corporation is considering an IPO. Kelly and its underwriter agree that the company is worth $500 million. Kelly's founders and early investors own 20 million shares of stock. Kelly has no debt, preferred stock, or short-term investments. The underwriters will charge a 7% spread. and Kelly wishes to sell enough shares that the new investors will own 20% of the company after the IPO. Assume that the direct costs of the IPO are negligible. So Kelly is an example of a company that knows how many shares they need to target. Although we need to calculate that in our first step, they know this because they have in mind what percentage of ownership they want after the IPO. So let's start by working through the problem. Step 1 is to find out how many new shares are needed. From the text, we know that if we take the percentage owned by new investors, multiply that by the number of shares existing, and then divide that number from 1 minus the percentage owned by the new investors. So let's plug in the numbers to get that. So the target percentage is 20%, so we multiply that by the 20 million shares. And we then divide that by 1 minus the 20%. That gives us 5 million shares. So in the IPO, they need to sell 5 million shares. Step 2, we're going to find the offer price. In order to find the offer price, we need to know the value of the company pre-IPO. That is given us to in the problem of 500 million. We're going to divide that by the spread multiplied by the new shares plus the existing shares. So as we plug in the numbers here, we're going to divide 500 million by the 0.07 spread multiplied by the 5 million shares that were going to be new, and then add the 20 million shares that I've already owned. When you divide all that, the answer comes out to $24.57. Now, as a point of comparison, the pre-IPO intrinsic value of Kelly's stock price was their $500 million value divided by the 20 million shares. And so their intrinsic price was $25 per share. Notice how the 7% spread affects the post-IPO share price by reducing it down to $24.57.